does, every single time. Let me show you. Stage 1 is the credit explosion. This is where it always starts. Not with greed, not with speculation, with debt. Before every major crash, there's a period where credit expands faster than the economy can absorb it. People borrow money they can't afford to repay. They use that borrowed money to buy assets. The buying pushes prices up. Rising prices make people feel wealthy. Feeling wealthy makes them borrow more. It's a feedback loop that feels like prosperity, but it's actually a trap being set. In the late 1920s, margin debt exploded. Ordinary Americans were putting down 10% and borrowing 90% to buy stocks. By 1929, total margin debt equaled the entire federal budget. Factory workers were leveraged like hedge funds. In 2007, it was mortgage debt. Banks created exotic instruments that let people buy homes with no money down. They packaged those mortgages into securities and sold them to pension funds. The leverage was hidden, but it was everywhere. In 2000, it was corporate debt. Companies with no profits borrowed billions to fund expansion. They used stock as collateral. When stock prices fell, the whole structure imploded. Now look at where we are today. Official margin debt sits around $750 billion. But that number is a lie. It only captures a fraction of the actual leverage in the system. Add in securities-based lending, where wealthy investors borrow against their portfolios, and you add another $800 billion. Add in the leverage embedded in options markets, where a small amount of money can control massive positions. And you add trillions more in notional exposure. Add in corporate debt, which has exploded to over $10 trillion, much of it used to buy back stock rather than build businesses. Add in government debt, which has crossed $34 trillion and requires interest payments larger than the defense budget. As a percentage of GDP, total debt in the American economy is now higher than it was in 1929, higher than 2008, higher than any point in recorded history. Stage 1 isn't just flashing red, it's on fire. Stage 2 is the concentration trap. Here's something they don't teach you in finance class. Crashes don't just happen because prices are high. They happen because risk is concentrated. When a small number of assets carry a disproportionate share of the market's value, the system becomes fragile. All it takes is one of those assets to stumble, and it drags everything else down with it. In 1929, the market was dominated by a handful of glamour stocks. Radio Corporation of America was the superstar. It went from under $2 to over $500 in a few years. People didn't understand radio technology. They just knew the stock kept going up. RCA made up a huge percentage of the market's value. When it cracked, the whole market cracked with it. In 2000, it was the dot-coms, Cisco, Intel, Microsoft, a handful of tech names. The NASDAQ was essentially a bet on 10 companies. When those 10 rolled over, trillions in wealth vanished. In 2008, concentration was hidden in the banking sector. 5 banks held the majority of derivatives exposure. When Lehman went down, it nearly took the whole system with it. Today, the concentration is staring us in the face, and somehow nobody seems concerned. The top 7 stocks in the S&P 500 now account for over 30% of the entire index. At certain points this year, it's been closer to 35%. Think about what that means. When you buy an S&P 500 index fund, which is what sits in most 401ks and retirement accounts, you're not really buying 500 companies. You're making a massive leveraged bet on Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. If those 7 stocks drop 50%, your diversified index fund drops 15 to 20%, even if every other stock stays flat. And here's the thing about those 7 stocks. They're all trading at valuations that require perfection. Not good earnings, perfect earnings. Any disappointment, any slowdown, any crack in the narrative, and the selling will feed on itself. Passive investing has made this worse. Every dollar that flows into an index fund automatically buys more of the biggest stocks, pushing their prices higher, increasing their weighting, which means the next dollar buys even more. It's a momentum machine that works beautifully on the way up. On the way down, it reverses. Every dollar that flows out sells the biggest positions first. Forced selling creates more selling. This is stage 2, the concentration trap. And we're deeper in it than we've ever been. Stage 3 is the smart money exit. This is the stage that makes me angriest, because it